Okay, so we will start with this one, then this will give you the background idea. Okay, so you see, how do you value uh, a stock? That is the question. Okay, before that, if I say, imagine there is, imagine there is a real estate. Okay, now there is a real estate. Uh, how will you value this real estate? Okay, there are like imagine there is a small shop, mobile shop. You must have seen outside railway station. Okay, now what do you think? You have you seen like that? Only one person will be standing and he will be selling all mobile accessories and all that stuff. Have you seen like that
Yeah.
outside railway station? What do you? Only one person will be standing there. Hardly there will be any space. Okay. So what do you think will should be the price of that shop? Any number, rough number you would like to quote?
So it depends on how much sales he's making.
Ha. So here you focused on the word sales. Okay. It depends upon how much sales it is making. Now imagine a big bungalow, in a remote village. Now how will you value this? It's a big bungalow in a remote village where there is no sales. Now how will you
Material,
value this? Huh?
value of the materials
Huh. So
which is
value of the
required for
material.
the
Okay. So how much money you have spent on the product? Okay, tiles, then all other cement and
the
all
cost
whatever
of production.
decoration. Yeah. So whatever cost you have applied or you have used for building that bungalow, you are going to apply that one. Okay. So moral of the story is, you know, uh, you are going to value it based on its strength. So this small shop, you cannot say it is a very small shop. It is not very big, so I will pay less. So there, the strength is what? The strength is it is just outside the station where lakhs of people are passing by each day, and it is able to generate a huge sales. So you have to value it based on sales. Whereas this is a huge property, but it is not creating any sales. Then you have to value it based on the amount that you have invested to build it. Okay, so that means there are different ways. Both are real estate only, right? Both are real estate, but there are different ways to value this real estate. Okay. Similarly, when it comes to equity, how do we value it? Okay. So when it comes to equity, how do we value it? See. So how do we value it? See. One is based on how much dividend I'm getting, because I am a small investor, minority investor. What I'm looking for is what? Dividends. So dividend discount model. I will discount dividend. What is this discount? I will let you know. Dividend discount model. Okay, dividend discount model. Second one is so based on the dividend, or else I can value it based on multi. Okay, discounted cash flow. Dividend discount model. Discounted cash flow model. Okay, then so that means this is similar to, you think like sales, how much cash it is going able to generate. Then second one is multiplier model. Okay, multiplier model as in multiplier as in uh, comparative way. Like, how will I value my home? Because my neighbor's home is sold for 50 lakhs, so my home's price is also 50 lakhs. We say like this, right? That is called multiplier method. Okay, multiplier, or else I can even say relative method. So relative, here simple one example is P ratios. price to earning ratios. Okay, that means we are comparing for earning 1 rupee, how much, in the same industry, another company is priced. Same way, my company should also be priced. Like my neighbor's home is 50 lakhs, so my home should also be for 50 lakhs. Then another one is similar one only, enterprise valuation. Enterprise valuation. Okay, that means EV method. EV, enterprise value. So enterprise value is this is for acquiring the company. When you want to acquire the company, that time you will use enterprise valuation method. Okay. Then so otherwise we don't use, like, otherwise as in as a minority shareholder, I will not be much worried about this enterprise valuation. Okay, what is this? We will be doing one example of all this. Okay, first method we will be doing multiple examples. The last two, enterprise valuation, we will be doing one, and another one is net asset value. We will be doing one example. Net asset value. Net asset value is this one, material. How much money I have spent. Similarly here, assets minus outside liabilities. Okay, fair value of the assets minus outside liabilities. Net, what is the net worth? Net worth of the company. Assets minus outside liabilities. Okay. So these are the different ways to value. Why different ways are there? Because just like why here different ways are there, because characteristics are different, even though both are real estate. Here this company is giving you stable, predictable dividends. So when they are giving you predictable dividends, you are valuing it based on that. Then this is majorly used for every, largely this one is only used, price to earning ratio. Okay, this is to acquire. When you want to acquire, you are not interested in dividends, that is too small for you. You are interested in how much the company is earning. Okay, so their enterprise valuation. Then otherwise, if imagine the company is not doing much business, then you will go for net asset value method. Okay, fine. Is this clear? Understood this one? We will be doing all this now with sums. Okay, yeah. So this is what is mentioned here. Free cash flow to equity. Okay, we will be seeing all these terminologies. Okay, free cash flow to equities. Now this part we have already done last time itself, right? Reverse stock split, reverse stock split. Stock dividend is bonus. Okay, chronology, dividends chronology is done. Now dividend discount model. Okay, dividend discount model. Yeah. So now see this question. One period dividend discount model. Calculate the value of a stock that paid $1 dividend last year. If next year's dividend will be 5% higher, the stock will sell for 13.45 at year end. The required rate of return is 13.2. Okay. Yeah. $1 next year's dividend will be 5% higher. Okay, so now let's draw the timeline. This is called timeline. 0 to 1. Okay, last year $1, that means here time 0 $1, and then next year's it will be 5% higher. So when I say 5% higher, how much will it be? Okay, 5% higher, how much will it be? Okay, uh, so it will be into 1 plus 5%. Just calculate this. 5% higher means into 1 plus 5%. Just calculate this. Acha, how will you calculate in your calci? Have
It's
you?
1.05.
Yeah, 1.05. Shravani, have you
Yeah.
understood this step? You have the calci with you, or you are using soft
Yes,
copy
sir.
only? You
No,
have
no, I
the
have the
actual
calcs.
one, right? Okay, so
Yeah.
I don't know if you know how to use calci. You know how to do this one? Okay, wait.
Yeah.
I'll just. Is it?
Yes, sir.
Okay, fine. Okay, but still, I'll just tell you because I don't want to
Okay.
take risk. I'll just quickly tell you. It will not take time. See, this is the one that you have, right? This one. So, if you are not sure about any numbers, how it is coming, you feel free to tell me. Okay. So how you should do is first you finish the bracket. Okay. So now in the bracket, when it is better to start with the ending. You may begin with one also, but it is better to start with the ending. It will help you in other complicated numbers. Okay. So here 5 percentage plus 1, think like this instead of saying 1 plus 5 percentage. So you do 5 percentage plus 1 equal to 1.05. Okay, into 1 into 1 equal to 1.05. Okay, 1.05. In case if it is minus sign comes, then you do properly. If it is 1 minus 5 percentage, then that time you don't do like this. You do properly 1 minus 5 percentage only. Okay, then
Okay.
uh, okay, then the stock will sell for 13.45. So they are saying year end the stock is going to reach to 13.45. Okay, the year end stock will reach to 13.45. Okay, now there are many ways to find out like how it will reach. So right now we are not focusing on how it will reach to. Say like you got to know somehow that it will reach to 13.45. There are high chances. Okay, so in this case that means in 1 year's time, I when I will sell, I will get how much money? Just add up these two.
It's 14.55.
14.5. Yeah, 14.5. No, this is the cash I'm going to receive. Okay, this is the cash I'm going to get. And the required rate of return is 13.2 percentage. So I'm supposed to discount it with the required rate of return. What do you mean by required rate of return? That means you are expecting this much from the company. So what you are expecting from the company, that you are supposed to discount it. Discount means what? 1 plus the discount rate. This is discount. Okay, raised to, now this is 1 year away. So raised to 1. Okay, just calculate this part. Now this also, Shravani, you may not be knowing like how to calculate this. See here, this one first you look at the denominator. So denominator is 13.1 percentage plus 1. So I'll clear this one here. This is clear work. 13.1 percentage equal to 0.13, sorry, 13.2 percentage. This is clear it. 13.2 percentage equal to, then 13.2 percentage plus 1 equal to, okay. Acha. Okay, the decimal point is the problem here. See, how many decimal are you using, Shravani?
-8.
8 decimal. Okay, fine. Okay. So here, so if you don't know how to change that decimal, this is the one format. Okay, the last bottom. So I should activate that format because format is on the upper side. So I should do second. When I will do second, this upper part will get highlighted. Then I will click on this dot. So format and the decimal, the DEC is decimal. Decimal right now it is 2. I want, let's say, 8 decimal. So 8, enter. Okay, then that's it. Clear work. Now I have 8 decimal. So now I will do 13.2 percentage plus 1 equal to, okay, 1.132. So denominator we have solved, yeah, raised to 1. So for raised to 1, y raised to x is the one. Okay, so y raised to x 1 equal to. So it will be 1.132. Okay, I do it again. 13.2 percentage plus 1 equal to, so then y raised to x 1 equal to, so 1.132. Now I have solved the denominator part, but actually this is 1 by, okay, so actually this is 1 by, okay, so it is like this: 14.5 1 plus 13.2 percentage raised to 1. So I have
It's
solved,
12.8
yeah,
809, so 12.81.
okay. So because this is 1 by, this I will consider denominator as x. So it is in the form of 1 by x. So I will inverse this 1 by x, this one, 1 by x, and then multiply with 14.5 into 14.5 equal to, so 12.809. So it comes to 12.809. Its price should be 12.809. Okay.
So why did we inverse it?
Ah, why did we inverse? Because this number in the denominator. So what I want is 1 by this number, not only the denominator. I want 1 by denominator.
You
Okay.
should just simply divide it, right? Like,
Huh? Huh?
why did you do the inverse thing? Like, we can just divide it, right? 14.5 divided by 1.132.
Huh. You, okay. So how you are saying is using this one, correct? 14.5
Yeah, and divided by 1.132. Like,
divided by, but in this case it is okay, divided by 1.132, but when if it is raised to 5 is there.
okay, so we'll just do like we'll just store the number, right? Y raised to x and then 5, and then again divided whatever the number
Hmm.
is.
Yeah, but this way without storing you can do, right?
Okay,
Because every time you will be using numbers, right?
yeah.
So this way you don't have to store only, no? Okay, see this one. I'll do it
You're
again.
using that x, y raised to x, and then 1 by x.
Yeah,
That thing you're doing. Okay.
yeah. So I have solved this one, but I don't want this one. I want 1 by this number so that I can multiply with 14.5. Okay, so 13.2 percentage plus 1 equal to, raised to 1 equal to, then inverse into, what is that number, 15 or 14.5, 14.5. Oh, what happened? 13.2 percentage plus 1 equal to, then y raised to x 1 equal to, inverse into 14.5,
Yeah, got it.
12.801. Is this fine?
Yes, sir.
Okay. Shravan, you understood this step? Why
Yes.
I have done this, discounted, uh, all this? Have you understood this one?
Yes, sir.
Okay, fine. Okay. So this is it. This is the first sum. Then next one, multiple period dividend discount model valuation. Okay, multiple period DDM valuation. Just go through this question now. A stock recently paid a dividend of $1.50, which is expected to grow at 8% per year. The required rate of return is 12%. Calculate the value of the stock assuming that it will be priced at 51 3 years from now. Okay. So paid a dividend of 1.50. Dividend of 1.50, which is expected to grow at 8 percentage per year. So into 1 plus 8 percentage. Okay, per year. So each year it will grow at 8 percentage. So just calculate how much is this coming to first year. 8 percentage plus 1 equal to, then into 1.50.
1.62.
1.62. Okay, Shravani, you got this number.
Yes, sir.
Okay, then second year also it is going to grow at 1 plus 8 percentage. How much is it?
1.75.
1.75. Okay, then again third year also it will grow at 8 percentage.
One point 1.89. 1.89.
Okay, yeah, 1.89.
89.
Okay, yeah. So and then at the end of the third year it will be sold for 51.
51.
Okay, so 51.
Right.
So add up, this comes to 52.89.
Yes,
So that
52.
means in the next 3 years you will earn 1.62. So
1
you will
point.
earn, yeah, you will earn 1.62.
And
You
1.7.
will 1.71. Then you will earn 52.89. So now all I have to do is discount. Okay, so 1 plus what is the discounting rate? 12 percentage required. So
12%.
that much I will discount.
So you'll
Raised
have
to
to
1.
add all of these.
Yes.
Okay.
You just calculate this value first of all. How
Okay.
much is this coming to?
The first one is 1.4464.
Hmm.
One point four five
1.44.
six four.
Wait. So when you get 1.4464,
Yeah.
okay, 1 minute. Wait. See, this is clear work. 12 percentage plus 1 equal to, then
1.12.
raised to 1 equal to, then inverse into 1.62 equal to 1.44. Yeah. Now you do the store 1. Shravan, you know this, how to do this store 1?
Yes, sir.
Store 1, you know, right? Okay, store 1. Okay, so store 1 you do. Then move to the next one. Next one is 1.75 divided by 1 plus 2 percentage raised to 2 because it is 2 years away.
Yeah.
So this one you clear it off. Then it will be 2%, 12 percentage plus 1 equal to, then raised to 2 equal to, then inverse
One.
into 1.75.
Yeah. 1.3950.
1.39. I'll keep it in store 2.
Okay. Yeah.
Store 2, 1.3950.
And then 52.89, right?
Yeah, this I will discount it for 12 percentage for 3 years. Uh,
It's 37.64.
okay, I'll also do here. So 12 percentage plus 1 equal to raised to 3 equal to inverse into 52.89. 37.64. Keep it in store 3. Okay. Now to add up all this, just to do, we have kept in store 3. Okay. Now clear.
Total is
Recall 1
40.48.
plus, yeah, recall 2 plus recall 3 equal to 40.48.
Yeah.
40.48 should be the price now. 40.49. Okay, that is fine. Just take a minute, go through this,
So I'll
and tell
copy.
me if you have any questions. You just let me know.
Understood, sir.
Yeah.
Just to make some
Ah,
copy.
okay. Yeah.
Done.
Done? Okay.
Yeah.
So then next one, free cash flow to equity. Okay. So now here there are plenty of formulas. Uh, this will come in FSA subject also, but still I would like to do that here as well because it is little tougher one. Okay, so I'll do now as well as I'll repeat in FSA as well so that it becomes easier for you. Okay, see, first of all, uh, you need to know free cash flow to the firm and free cash flow to equity. What does that mean? See, the functional classification of income statement, functional classification of income statement is like this: sales or revenue. Okay, you can say revenue also, minus cost of goods sold. What will you get? You will get gross profit minus sales general administration expenses. Sales and general administration expenses, you will get EBITDA minus depreciation, you will get EBIT minus interest, you will get EBIT is earning before interest and tax. So minus interest, you will get earning before tax. Minus tax, you will get earning after tax. Net income, also called profit after tax, also called uh, net profit. Okay. Have you understood this one? What I have written here?
Yes.
Okay.
So what is the second one?
Cost of goods sold, then gross
Okay.
profit. So
Okay.
from the sales, so imagine if I give you one rough idea, you have done sales of 100 rupees. Out of that sales, you bought that goods for 60 rupees. Bought as in you spend 60 rupees to manufacture. Okay, let's say you have sold mangoes and the cost of the mango was 60 rupees, so you got 40 rupees profit, but then you also spent some money in transportation expenses. So in transportation you spend 10 rupees, so your EBIT, the earnings, now it is 30 rupees. Earning before interest, tax, depreciation and amortization. Amortization is always zero only. We don't have to care about amortization. Okay, 30. Then depreciation, imagine you have spent 5 rupees depreciation of some fixed capital, fixed assets. Okay, then now your earning before interest and tax is 25 rupees. Now imagine you have borrowed money, so because you borrowed money uh, to buy mango, so you have to spend 5 rupees interest. So earning before tax is 20. Now imagine you are paying 30 percentage tax. So 30 percentage tax is 30 percentage of 20 comes to 6 rupees. So you will be left out with how much? 14 rupees as your net profit. Fine, okay.
Yes, sir.
So now what is free cash flow to the firm? That means how much free cash flow is there with the firm. See here, uh, free cash flow to the firm. Firm means, when I say firm, it includes both equity holders and equity holders plus bond holders. Plus bond holders. Okay. So uh, now, uh, how much free cash is there with you? So I cannot say 14 rupees is there with me. Why? Because you see, this depreciation is not a cash. correct? It is a non-cash item. So I still have this cash also with me. So that means net income is not my cash available. Is this okay? First of all,
Yes,
net
sir.
income is not the available cash with me. So how do I calculate this? So number one, first of all, net income, which is what? 14 net income. And then I know even this interest also I have deducted, but I'm taking here both, as you know, they both are brothers. They both are within the same family. So that means what has been paid to my brother is also within the family only. And I am finding out how much cash is there within the family. So this cash is within the family only. So I will add this also. This is plus interest into 1 minus tax comes to uh, plus interest into 1 minus. This is the interest I have paid, right? So that comes to how much? 5 into 1 minus 30 percentage comes to 3.5.
3.5, right? 3.5.
3.5. Okay,
This would be
3.5.
5 as it is, right?
Huh.
Depreciation.
Yeah. Okay. So 3.5. Then this depreciation is fully there with me. So plus depreciation is 5. Okay, rest is all fine. Rest is all fine. So these two are the problem. Now, so that means, can I say all these cash are free with me? Still, I cannot say free. Why? Because now to run my business, I need working capital and fixed capital. So I need working capital and fixed capital. So for my next cycle of business, let's say I normally spend, let's say no, I normally spend my working capital investments. My working capital investment is maybe like 10 rupees, or maybe like, let's say 4 rupees is my working capital. And also I spend some money on fixed capital expenses, fixed capital investments, which will be maybe like 10. Okay, so now you calculate. Okay, this is minus minus
8.5.
8.5. This is called my free cash flow to the firm, 8.5 rupees. Have you understood why I'm doing like this? Because this much is there in the income statement itself, and this is for my next cycle of business. I have to keep this money aside. It is like, imagine you are working in a company and which is giving you 1 lakh cash salary. Now, does that mean all 1 lakh is, now freely, like you can do anything you want? No. You have to spend, you have to keep some money aside for rental charges. You have to keep some money aside for eating. Okay. And then whatever is left out, only that is completely free, which you can do anything you want. Is it okay?
Yes, sir.
Yes, sir.
Okay. Now, there are multiple ways to reach to this free cash flow to the firm. So this is one formula: net income plus interest into 1 minus tax plus depreciation minus working capital investments minus fixed capital investments. Now, free cash flow to the firm. Another way is uh, a bit, a bit point of view. So suppose in the question, uh, this is net income is not given, but EBIT is given. Then how will I do? So that means you know, initially, okay, initially, uh, I used net income, and from there I was going in the descending order. Then I got to know that interest I have to change, depreciation I have to change. Now I'm going to see from EBIT perspective. Now when I'm going to see from EBIT onwards, from EBIT, so there is no interest wrongly deducted. So there is nothing for me to wrongly add back that interest. I don't have to add back to rectify. Okay, so now what will I do? I will directly pay tax. So into 1 minus tax, into 1 minus tax. So that comes to how much? So that comes to EBIT is what? EBIT is 25 into 1 minus tax is
17.5, right?
30 percentage.
Yep. 17.5.
So 70 percentage of the 25 is how much?
Yeah, 17.5.
Okay, 17.5.
Yes.
Okay. Okay, 17.5. Now, okay, so interest is not deducted, directly tax paid on that amount. After that, here depreciation. See, up when I go, EBIT shows that depreciation has already been deducted, and then only I'm getting EBIT. So depreciation is a non-cash. So I still have that 5 rupees in my hand. So plus depreciation of 5. Okay, and then so that's it. This is the problem in this one. Rest all are fine. But I will reduce working capital investments also. Let's say 5 rupees and fixed capital investments, which is 10 rupees. Let's say. Now you calculate this 17.5 plus 5 minus 4 minus 10.
8.5. It's the same.
8.5. Yeah, it will give you the same output. Yeah, 8.5. This is okay.
Yes.
Same answer. Okay. Then next one might be very tricky for you, but just try. Next time again, I will re-explain all this next time. Okay. So next one. Suppose if the story begins from EBITDA into, so from EBITDA you are paying tax. So EBITDA is how much? EBITDA is 30. So 30 into 1 minus tax is 30 percentage.
So 21.
21. Okay. 21. Okay. Then after that, uh, so from EBITDA, I have paid taxes. So up everything is fine, only SGA, GP, cost of goods
So
sold.
we,
So here,
we we do not have to add back interest and depreciation, right? In this case.
yes, yes. So now I will do minus working capital investments, right? Which is 4. Then I will do minus fixed capital investments, which is 10. Now you calculate, it will not match to 8.5.
No,
Just check
it's 7.
how much.
5 less 7.
Yeah, so then there is something wrong. So what is wrong here? Now that is one tricky thing to understand. See, here when I'm directly paying tax, so if I'm, so this is 30. Okay, now uh, okay, let's take one more example to understand this. Uh, I'll keep interest as 0 and explain. See, EBITDA, EBITDA minus depreciation, EBIT minus interest, earning before tax minus tax, earning after tax. Now If I say 110 is my earning before EBITDA, 10 is depreciation, EBIT is 100, take interest as 0, this is 100, tax is 30 percentage, let's say, so this will be 30, earning after tax is 70. Okay, now if I directly pay tax from EBITDA, that means I will pay how much directly? 30 percentage of this is how much? 30 percentage of uh, so here uh, so that means I'm not including depreciation, so this becomes 110. I'm not including anyways interest. 110, so 30 percentage of the 110 is how much? 33. So now you see here the problem is when I'm directly paying tax or reducing tax from from EBITDA, my tax is coming to how much? 33. That means ideally it should come to what? 30. But here it is coming to 33. That means I'm paying more, it looks like, right? I'm paying
Yes.
more here. I'm paying more. Why? Why am I paying more here? How is it coming more? Interest both the side is 0, 0. So leave that one. So what is the difference? It is the depreciation. You see, because I didn't account depreciation here, I'm paying wrong amount. So how much is this wrong? This is wrong to the extent of the 30 percentage of depreciation. This 3 is nothing but 10, right? 10 is what I'm missing. 10 into 30 percentage, you see it is 3. So that 3 extra tax I'm paying here. I'm paying extra tax when I directly reduce tax from EBITDA. Is it okay? So that means now what to do? That means this much I need to add back. This 3 rupees I need to add back. How will I get that 3? Depreciation into tax. I will get back depreciation into tax. Okay. Is it difficult? You are finding it difficult?
No, sir, understood.
No, understood? Okay. So this much is extra. So I'm going to add that as well here, plus depreciation into tax. That comes to how much? Here in this case, what is the
3.
depreciation? 5.
It will be, yeah, 5.
5 into 30 percentage. So
It's
1.5.
70%, right? The tax.
No, 30 percentage. It is not 1
Okay.
minus tax. It is directly tax.
Okay.
So 5 3s
Uh,
are 15.
1.5.
1.5, right?
Yeah. So then, yeah, it's 8.5.
8.5 matching, right? So in the video, just watch all this once again, okay? It's a very important one. Okay. There is one more also, uh, that is called another way, that is called cash flow from operations. So there is a big sum in FSA about how to calculate cash flow from operations. So we will not go there now. So you just think that from this one, you directly take it at the moment, minus, uh, uh, no, not minus, plus interest into 1 minus tax. Okay. Then minus fixed capital investments. This will give you again FCFF. The logic you will understand better in FSA subject. Okay. And suppose, okay, I'll just finish in 2-3 minutes. I'm just writing this. Next time I'll explain, because I think beyond 11, because I don't want to extend. You might be sleeping. See, free cash flow to the equity we will be seeing, or else we will see this next time. Free cash flow to equity. See, what you do at home is just watch this once again, okay, and try to make sense out of this. If you feel any difficulty, you tell me. Next time again I will recap. See, this is there in level 1, ditto it is there in level 2 as well. So if you are comfortable in this one, you will certainly get questions, few questions from this level 1 also, level 2 also. So that's why it is very important one. Next time, if needed, tell me. I will again re-explain this. Okay. We'll stop now here.
Okay, so
Okay. Yeah.
Okay.
Okay then. Okay. Okay.
so like
Ah.
we can have a class on this coming Sunday, right? Like we can have a class for longer duration.